Good afternoon, everyone, and you're all very welcome to CFA Ireland's webinar, Anatomy of the Bear, Lessons Learned, Lessons Applied with Russell Napier. My name is Niall MacDonald, and I'm the head of the Member Value Committee here for CFA Society of Ireland. Most importantly, on behalf of the Society, I'd like to say that we really hope everyone and their families, friends and colleagues are safe and well in these stressful times. The COVID crisis has led us all to adapt how we work, and the CFA Society of Ireland is no different. Our enthusiastic team of volunteers and staff have been working hard to set up and continue to deliver engaging and thought-provoking events for our society members. And I'll have more details on what's in store at the end of this webinar, so please stay tuned. Today, we're deeply honoured to have Russell Napier present on the Anatomy of a Bear, Lessons Learned, Lessons Applied. Professor Russell Napier is the author of The Solid Ground, an investment report for institutional investors, and co-founder of the investment research portal, ERIC. Russell has worked in the investment business for 30 years and has been advising global institutional investors on asset allocation since 1995. He's presently a director of the Midwin International Investment Trust. He's a member of the Investment Advisory Committee for two fund management companies, Cerno Capital and Kennex Asset Management. And Russell is the author of the book, Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. And he's a founder and course director of the Practical History of Financial Markets course that is part of Edinburgh Business School MBA. For the structure of the webinar, Russell will have a presentation, and this will be followed by a Q&A, and you can submit questions throughout on the Zoom application. You will see his button at the top where you can submit, and these will be moderated by our volunteer, Irina Bebza. Please bear with us as we work through this technology. This is our inaugural one, and feedback is always welcome post the webinar. So without further ado, Russell, I'll hand over to your good self. Thank you.
Thanks, Niall. Thanks very much. I'm very disappointed because I'm supposed to be doing this in Dublin, but I'm doing it from my study in my office here in Scotland. Why don't we start with a quote from Seamus Heaney, which I think is apposite for our times. If we winter this one out, we can summer anywhere. I've got a slight vested interest in that because I'm involved in the brewery, which now sits on the Heaney family farm. So I look forward to getting to Dublin sometime and sharing a Heaney beer with you when the time comes. What we have to winter is pretty severe. And obviously I can't and I won't talk about the health crisis because I have no insight into timing on that, and I'm not an epidemiologist. But what I do want to talk about is why this creates a huge structural shift in the way our industry works and what you should do about it from an asset allocation perspective. And there are people who are skeptical that it changes anything. And I've thought for 4 to 5 years this would change something. So that's not to say that I saw a health crisis, because I certainly did not. But what I've seen coming for a long time is the failure of policy to reduce debt to GDP ratios. In fact, it was a policy which has pushed debt to GDP ratios up, with a notable exception actually in the case of Ireland, but in most countries. And that when the next recession came, and my goodness, it has come with a bang, we would have to revert to a whole new way of running the financial system to bring down debt to GDP ratios. So that's what I'm going to talk about. So that is not directly related to this crisis. It would have, in my opinion, been caused by any crisis because debt to GDP ratios were so high. So let's start with where they are and start with some conclusions, and then I'll go through the reasoning for the conclusions. In speaking to my friends at CFA Ireland, I said, well, I could rush through this and do this in half an hour. And they said, oh, take your time. They may regret they ever said that. So here are the conclusions, and these debt to GDP ratios are significantly higher today. So what we're looking at here is total debt to GDP. You'll often see data quoted for government debt to GDP as if that really matters. And I think for some things it probably does matter, but for us as savers, as investors, as the stewards of capital, it's total debt to GDP that really matters, as Ireland discovered out to its cost in 2007, because Ireland entered the GFC with one of the lowest levels of government debt to GDP in the world, and ended up with one of the highest. And that was, as you are all too well aware, because certain private sector liabilities rebounded onto the balance sheet of the state. So it is dangerous, I think, just to look at government debt to GDP. We need to look at total debt to GDP. And certainly if you were going to de-gear a society and de-gear a financial system to make it robust in the face of recessions, you would be looking at total debt to GDP, not just government debt to GDP. And that's what I'm going to do through this report. And you can see that we are well above 2007. Now, this data comes with a significant lag, so I think we all know What is currently happening in our economies is that total debt to GDP ratio is going up even more dramatically because A, GDP is coming down, and B, government spending is going up. I'll show you that this will take us to levels never seen before in human history. It's a big thing to say, given how many wars that have been fought and how much debt has been accumulated to fight those wars, but we really are in uncharted territory for total debt to GDP, if not necessarily warfare scale government debt to GDP. Now, the solutions below that are the ones you'll have to pick when you are going to allocate capital for the long run. I don't know of any others, and if you do know of some others, please let me know. But I think it's actually a very limited menu, which is always helpful when you're forecasting the future. But each single one of those solutions will be chosen by a politician, not dictated by the markets. The politician will dictate these policies to the markets, and you, as someone who's investing in the markets, will have to respond to them. So there is austerity. I think you know what that means. It's proven very difficult. It's also proven to have grave political ramifications. Default, I'll show you that has historically created great economic turmoil, particularly as most defaults have been associated with people defaulting on their foreign currency debt. We don't actually have a lot of record recently on people defaulting on their domestic currency debt for the simple reason that it's usually been much easier to use some of these other mechanisms than actually refuse to pay principal and interest on local currency debt. And you'll be familiar that inflation is one of the ways that we do that. So default has had historically very bad ramifications for re-election, which is what was important, but also the economy. High growth is a nirvana that we all want. It's one that Ireland to some extent has pulled off pretty dramatically since 2013, but is really more the exception than the rule. It would be wonderful, and I would be incredibly optimistic if we could get our debt to GDP ratio down through very high real growth, not nominal growth, but real growth. But it's probably unlikely. Hyperinflation, possible, but obviously comes with its own implications. And then there's repression. And I obviously think it's going to be repression. And the point of this presentation is to tell you why it's going to be repression, what repression is, and what you do about it. And here's what you do about it. You don't invest in bonds. That's pretty straightforward. Government bonds become certificates of confiscation in a financial repression. What is a repression? That's the point of this presentation. It'll be a long one, but it's basically keeping the bond yield below the level of inflation and keeping interest rates below the level of inflation. And if you can carry that on for long enough, then gradually your debt to GDP ratio comes down. And that best example of that would be the United Kingdom after World War II. Where it did indeed come down, but it took decades to come down. So I think one of the key things about repression is to tell you that it takes decades to bring this under control. We're not talking about something that's around for a year, 2 years, 3 years, 5 years, or 10 years. It is almost certainly going to last much longer, and that is a prolonged bear market in bonds. And I'll also come back to why equities may not do as well as you might think, but they should do better than bonds. Why does it change the whole nature of what we do? Because it's a bull market in the word controls and a bear market in the word market. And for the last 30 years, we've been in the reverse of that, really, haven't we? We've been in a situation where on the whole, we've had more markets and less government. Well, that is reversed. Two specific measures, which are just here in the conclusions to focus the mind, credit controls and capital controls. Both are likely and both have occurred in previous financial repressions. I can't think of nothing more profound than the way asset prices will perform than a restriction on where credit flows to, which is the politicization of credit through the banking system, but also ultimately through the markets. But also capital controls. We've all been used to, if you like, playing our game of investment chess in 3 dimensions. And with the imposition of capital controls, that becomes 2 dimensions. We have not yet had a successful financial repression without capital controls. And it will change things. They've been used already for certain purposes in Greece and Cyprus and lifted, used again in Iceland, used in numerous emerging markets, now endorsed by the IMF in an incredible article in the Financial Times on the 18th of February. So they are much more likely than we think, and nothing will change your life, the life of savers, and the life of the stewards of capital more than capital controls. Now, I've been asked by the CFA to dwell on the next one, and I will come back to that in more detail. But it will be very, very difficult to engineer financial repression within the Eurozone. If it was a fully federalized system, then it would be much more possible, but it isn't. There are certain institutional limits made absolutely clear yesterday by the decision from Karlsruhe that mean pulling off a financial repression in Europe will be particularly difficult. And I see the European Commission today bluntly stating that without greater federalisation, we might see the end of the euro. And I think they're right. I think we will see the end of the euro, but not in the way that most people think. So one of the greatest casualties of this COVID-19 crisis will be the euro, because it will bring forward the need for a repression, which I think is politically very difficult, maybe not impossible, but very difficult within the Eurozone. Can emerging markets avoid repression? Possibly. Who has to repress? People with very high levels of debt to GDP. Emerging markets have much lower levels of debt to GDP. So I'm leaving that as a possible. It depends a lot on what happens to debt to GDP going forward. And as you discovered in Ireland, you can actually enter a recession with a very low level of government debt to GDP, but end up with a very high one. So it's kind of watch this space for emerging markets, just to see how much of the private sector liability rebounds onto the government, would be number one. But number two, the great flaw in most emerging markets is they tend to borrow in foreign currencies. So debt to GDP ratios can really rise astronomically quickly if you have a devaluation. So a little question mark there, but a certain possibility that to avoid repression, you may want to look at emerging markets. The place to avoid repression, in my opinion, is Singapore, which we'll come back to, and potentially Switzerland. So the final point on what I'll be running through here is the 1945 to 1980 period, all the mechanisms that engineer a financial repression. It sounds easy. If I say to you the government's going to keep the bond yield below inflation for 2 decades, you think, right, got it, let's move on to the next point. It's the mechanisms you need to keep that bond yield down which completely change the whole business of capital and savings allocation. And that's what I'll be talking about. Now, there is the historical debt level. It runs back to 1880 for the developed economies. It's the longest I could get it for all developed economies. You can pick out the United Kingdom, you can pick out the United States, and we could actually get it going back a bit beyond that. But when you put them all together, that's what you get. Now, based on what's happened, this is just government debt to GDP, but based on where we are, what we are living through today, this is almost certainly going above World War II levels, which is just incredible. Now, the problem obviously is where we started. We started with incredibly high levels. We didn't start with low levels. Had we started with low levels, perhaps as we did going into World War I, then we would have manageable levels of debt to GDP, which didn't result in great need for changing the whole savings system. Optimists, and I have met a few, look at 1945 to 1980 and say, look, it can be done. Why are we so concerned about this? Look how we successfully reduced debt to GDP ratios from 1945 to 1980. Not only that, the economy was growing from 1945 to 1980. For the man in the street, particularly maybe for the first 20 years of that, that didn't look too bad, the sort of growth that was coming through, and yet ended with an inflation problem. What's the problem? And the answer is there probably is no problem unless you're a saver. And that's the point of this presentation. It's directed to savers and you represent them. And if you own British government debt from 45 to that 70 period, I think it was 81 for the United Kingdom, you managed to lose about 90% of your purchasing power as a saver by owning government debt. A repression is not the end of the world. It's just the end of our world. A repression for the man in the street might look something like this. It might be wage growth at 6. Bear with me, seems unlikely at this current time, but let's say it's wage growth at 6. And a yield curve at 2, so that most forms of debt, particularly those secured on housing, is probably priced at 3 or 4. Now, if inflation is 6 and wages are 6, there's an element of money illusion, obviously, but actually there's a genuine benefit if interest rates are kept low and if the cost of debt is kept low. And it's a direct transfer from older people to younger people, older people trying to survive on that low yield of 2 to 3% while inflation is higher. It's a massive reallocation of wealth within society. And those who benefit from it are probably in a majority, particularly in a country like Ireland with a younger demographic. So that is the role model that our policymakers have, that this 45 to 78 to 80 thing was incredibly successful in their eyes. And let's be frank, it's better than the alternatives. I once did this presentation and there was an ex-member of the Bank of England in the room. And I was not positive about financial repression because of the impact it has on savers. And he came to me afterwards and said, any other bright ideas? And when you look at the list of alternatives, this is the one that is considered to be socially acceptable. And it has the added benefit in the eyes of policymakers that it definitely redistributes wealth from the older to the younger. And that tends to be from the richer to the less rich, let's even say to the poor. Now, I would argue strongly that if you look at the whole period from 45 to the current day, you see a profound change in the nature of way money is managed. after the end of financial repression. That is the one we've all lived through. So in many ways, our skill set is the wrong skill set. We need to relearn the skill set that helps us manage money in a financial repression. And I argue this, though nobody takes me seriously. Now, what you should really do is get all the people who've managed your emerging market money and get them to manage your developed world money. Because financial repression, or some of the consequences of it, potentially have very high inflation, devaluations, government control of banking systems. Now, not every emerging market's done that, and some have done it more than others. But if you're a sort of a seasoned emerging market investor, you've kind of seen this stuff over the past 30 years. But if you're a seasoned developed world investor, you ain't seen any of this before. You're going to have to learn a whole new set of skills. So that skill set, I think, probably exists, not fully fledged anywhere, but emerging market investors probably got a little bit more of it. So this is why I'm calling for something exceptional. It's not just this chart, as you'll see in a second, but really we are in exceptional period of government debt to GDP. Last time we were here, we had followed an exceptional policy. That exceptional policy was called financial repression, and it was aimed at moving money from savers to elsewhere in society, which interestingly is exactly what Martin Wolf calls for today in today's Financial Times, though he doesn't tell us how he's going to achieve it. And I think that's probably the secret of financial repression. I once did a talk for Money Week, and was a lady in the audience who was retired, and she asked me, she said she really hadn't really understood what financial repression was, and could I explain it to her in simpler language? And I did, by saying that it's stealing money from old people slowly. And the slow bit is kind of important, because you mustn't frighten the horses, because if you frighten the horses, they bolt. I'll talk about why that's not going to happen either. So this is now looking at not just government debt to GDP, but also private sector debt to GDP. And it's just America. Now, the reason it's just America, it is in America that we have the best data for private debt to GDP going back a long way. As I mentioned, for government debt to GDP, there are some countries we can go back into the 18th century. But the data set on private debt to GDP is pretty poor. But fortunately for America, we have it. Not quite to the end of World War II, but almost. And here's the crucial thing about this chart. If you go back to when it begins in 51, what you see is there isn't very much private debt to GDP, and contrast it with where we are today. So we're not looking at the same sort of financial repression that came in 45, when you had a high government debt to GDP and a low private debt to GDP. And the blue line is the aggregate, and you can see that's running at about 135%. And look where it is today before this crisis struck. Total debt to GDP has gone to a much higher level. Now, that has so many profound consequences, but one of the most important ones is, in the last repression, you could let the debt to GDP ratio of the private sector go up. In fact, if you look at that first 30 years of the repression, total debt to GDP is going flat. But in that, you've got this great rotation from government debt to GDP coming down, private debt to GDP going up. And as the private sector is the key engine of growth and tax revenue, that was incredibly helpful in solving this problem. But where we are today is that is highly unlikely to be permissible, to allow private sector debt in aggregate to go up relative to GDP. That is a source of growth, if you like, moving from the command economy of 45 to the consumer economy, which was rampant by the 50s, isn't what we're going to do. That engine for growth isn't going to be there. And it just means it's going to have to be much, much tighter control over who gets private credit growth, because it's going to have to come down in aggregate, but you would want it to go up for corporations which are doing things which are productive. Now, I could spend an hour just talking about the word productive, but that word will be determined by policymakers, as it was in the repression. And people who used money productively got credit, and those who didn't. And productive was effectively employing people. I'm old enough to remember and live not too far away from the great DeLorean plant in Belfast, which was a classic example at the very end of repression of a great flush of credit to a project which was supposed to be socially useful because it was going to employ lots of people. Those are the sorts of projects that happen in repression and get credit, and it turned out it wasn't a very efficient allocation of credit. And the people who don't are people who speculate. Now, the speculation production, that division, is one that I wouldn't like to get involved with. It's an incredibly difficult place to draw a line. But in a world of rationed credit, that's exactly the line that is drawn by politicians and not by markets. So this hopefully is giving you some idea of the world, why the world would be very different. So you can see total debt to GDP. We are, that was 1951. Unfortunately, we don't have the data to 45. But beyond all reasonable doubt, we are way, way above where we were in 45. So the need for repression is actually much higher than it was even after World War II. I'm going to kind of leave that. There's lots of debate about what debt levels mean for growth, and a lot of argument, a lot of discussion amongst economists. We'll leave that to the economists. I would just point out in the second point, though, that historically governments have tended to do something when government debt to GDP has gone above 100%. Even the Japanese tried something briefly, I think it was 1996. So there is kind of a trigger point for government debt levels to make policymakers think that they should do something. So basically across the board, outside of emerging markets, we have that 100% number. So something is to be done, or what is to be done, as Vladimir Ilyich Lenin once famously said. And what is to be done is that governments will want to bring this down. All we've got to do is work out how they bring it down. Once again, that point on Ireland at the end, the actual government debt to GDP level, as reported, may not be that successful. We're witnessing, as we speak, huge private sector liabilities boomeranging onto the public balance sheet. So let's not judge on who has to do repression by the size of government debt to GDP, but let's focus on the total. And the important thing about the total is it's definitely above World War II levels, because private sector debt to GDP in that command economy system was really very low. So we are in uncharted territory for total debt to GDP. Therefore, policy may have to enter uncharted territory. And I mean that, because I mean this could be a more severe financial repression than post-World War II. So here are the ways that we can do this. Austerity, you've had a dose of that in Ireland, and it has had created a political earthquake in Ireland. We had a little dose of it in the United Kingdom. Did it create a political earthquake? Well, it certainly cost George Osborne his job, that's for sure. Austerity has worked in the past, particularly after World War II. Obviously, the spending you were stopping as a government was not social spending. You were stopping spending on killing people in warfare, and we don't live in that sort of society today. It's very hard to cut back on this type of spending, which is so necessary for so many people in the population. So you may disagree, but I think austerity is highly unlikely, and it would not be 3, 4, 5, or 6 years of austerity, given that total debt to GDP has reached a new all-time high. We're talking about a decade or 2 decades of austerity. I don't think any political party really would choose that. And even if they chose it, I'm not sure they would be in office for very long. Default, where you simply don't pay back your debts. I'm a bit of a fan of this for the private sector. I should prefer the word restructuring. Not something we have maybe time to go into today, but I would certainly like to see lots of debt owners or providers of credit to companies becoming equity owners and taking some of the pain this time, as opposed to demanding government bailouts. But anyway, this refers to government default. And as you can see, the Bank of England study estimates that you'd lose instantly 7% of your GDP if you default on your government debt. We've seen Greece has done a recent, let's call it a restructuring, and the economy continues to struggle. So default possible, but not probable. And to stress again, hasn't really been chosen. Russia, I think, was the last pure example of a government that chose to default on its own debt. Greece default was really forced upon it by the Troika. So people tend not to choose it because they're easier and better ways of doing it. Real growth, fingers crossed, unlikely. Come to your own conclusion. Hyperinflation. So you can bring this debt to GDP ratio down very quickly, and France did that after the war by owning the banks and owning the insurance companies and forcing the banks and the insurance companies to fund the government at 6% interest while growing the nominal GDP by over 50, clearly replete with inflation. Quite high real growth as well. I mean, that's what happens when you reconstruct after a war, something we are fortunately not doing this time. So there was reasonable real growth, but lots of inflation, and your debt to GDP ratio falls quickly. We can, of course, choose to do that again. It's a massive reduction in this thing. It's a massive transfer of wealth away from savers. It's highly socially disruptive. It also gets out of control. It has political ramifications, particularly in Europe, associated with Weimar and what came after Weimar. And I think few politicians would choose this as a path, but it is always there as an option. Now, repression is really the same thing, but the difference is the gap between the inflation rate and the interest rate. You just keep it at a much more reasonable level. So a good example of that is the UK after the war. And the UK got over 30 years what France did in 5. And you can argue which was actually the better way to do it, but it's the same thing, one presumably more socially cohesive. After warfare, these things are often possible because it's seen that wealth is in the wrong hands. Wealth is in the hands of the corrupt, wealth is in the hand of the collaborators, and extreme measures are often taken in situations like that. And I don't think that's where we are today. and other extreme measures that we'll talk about have also happened after wars, like capital levies, where you simply take the wealth of the wealthy to pay down the government debt. But those are usually in situations where the wealthy are clearly culpable in some sort of crime, literally some sort of crime. So we had it in Italy after World War I, and we had it in Japan after World War II. So moving wealth now is the key, but it's moving it away from the people that you represent to somebody else. That is effectively what's here. So we're talking about which of the ways that's going to happen. So I think repression, it seems to me the most socially cohesive way of doing this. Policymakers look at 45 to 78 and think it wasn't too bad. They'll probably go for, I think it is bad for savers. So here's just some of the other things that you can achieve with repression. You can basically lock up all this debt on the central bank balance sheet forever, and it ceases to become debt, and it never has to be repaid. And all you have to do is then control the liability side that the banks have created, the central bank has created, and expanding this asset side. And it's quite easy to control the liability side if you control the banking system. So we run forever with very large central bank balance sheets, and this debt, which isn't debt, I mean, it's never paid back. There's no interest on it because all the interest is rebated to the Treasury. And where I come from, if I make you a perpetual non-interest bearing transfer, we call that a gift, not debt. So the alternative is that you then have to control the banking system. Otherwise, all the reserves you create in buying that debt can go ballistic. Let's go back to Keynes, the euthanasia of the rentier. That's you, by the way, or at least you represent the rentier. It's easy to be against something when you put it in French, right? So rentier means you, the saver. Euthanasia of the saver. Interestingly, picked up by Paul Krugman as the quote for our times. I quote from Krugman. And Martin Wolf today also would say it's time for euthanasia of the rentier. So you are on the wrong side of history here, because you're supposed to be defending this rentier and the rentier's returns, the saver. And that is the battle which will go on for a long time. So wintering this one out might take a while. So here are some of the policies of repression. They'll never be called repression. That is the first thing we have to remember. If a government's going to make the same mistake for the second time, actually in this case, the third time, it will have the good grace to give it a different name. Now, this one comes mainly under the rebranded name of macro-prudential regulation, which almost scans with motherhood and apple pie. And that is not coincidental, because who could be against macro-prudential regulation? You'd be pretty pushed to stand up in public and damn something with such a wonderfully prudent name. But anyway, that's what I do on a regular basis, and here I am again. The role of this is to force you, I mean you the saver, or you the representative of the saver, to own assets you don't want to own. That's what it's all about. And the one asset that they really want you to own is government debt. Now, there are regulations which are already forcing financial institutions to own government debt, whether we do that through the Basel III rules, the FPC of the Bank of England, already doing these things. You can change capital risk weightings for banks that make some assets more attractive than other assets. You can ultimately just do credit controls and say, here is the growth of your balance sheet this year, commercial bank, get on with it. Oh, by the way, here are the people that we actually think you should prefer lending to. Once again, I'm not making this up. This is what happened the last time. You might like to call it capitalism with Chinese characteristics, but we instantly politicize credit. Many years ago, when the FPC was being set up, it used to be called the Bubble Committee before it had a formal name. Someone said jokingly, we had a member in the room, or a new member in the room. Someone said jokingly that I should join the committee. I said I joined the committee if I could one day point out that government bonds were risky. And a great laugh ran around the whole room. And it tells you everything you need to know about these controls. These controls have got nothing to do with macroprudential regulation and everything to do with keeping money in the government bond market. And there is no conceivable way that any of these regulators would independently conclude that government debt is too risky. Or if they do, I will be very surprised. So there's one crucial way we've already got there, and that will now clearly exacerbate. I need to speak a little bit about the COVID-19 response because it is doing something fundamentally different from previous responses. The government have effectively taken control of the banks, and by doing that, they're trying to get the banks to expand their balance sheets. They're trying to get them to expand credit, and we might well find at the end of this recession, the bank balance sheets are bigger than when we began, which is a very different from the last recession. Remember, under fractional reserve banking, if a bank increases the size of its balance sheet and its assets, it is that unique institution which simultaneously creates its own liabilities in a form we call deposits. So when a government takes control of a banking system and mandates that it expands its balance sheet, it is running the printing press. That's what it is doing. Now, it's not doing it from the central bank, it's doing it from the commercial banks, and that is what is done. And that is what is done in China, and that is what is now being done in most places in the world. We believe, I think most people believe, that this is a temporary measure brought in to fight warlike conditions. Well, we'll see. Every financial repression so far was brought in to fight a war. I mean, a real war. None of them ended when the war was over. They continued afterwards because the legacy of the war is a level of debt to GDP which has to be reduced. And in our case, reduced from an astronomically high level. So don't believe that just because the state is, and in Ireland, of course, the state actually owns banks, but just because the state is actively involved, whether it's in France or Italy or Ireland or the United Kingdom or America or even Hong Kong, that is actively involved in pushing credit through the system now, don't believe that it necessarily is going to retreat. And if it remains and retains that control to build the land fit for heroes, to create a Marshall Plan, then it really does give the politicization of the whole credit system. The government will mandate interest rates. Regulation Q is an American piece of legislation, actually dates from the Great Depression, but was maintained right up until about 10 years ago, I think, technically. And that would mandate the level of deposits that banks could charge. They wouldn't be allowed to charge a level of deposits that they thought was appropriate for their own business. The crucial reason, you want to keep deposits less attractive than government bonds and try and get money into government bonds. Capital controls, I've mentioned, have been essential. Even in America, where the government debt to GDP ratio was relatively low after World War II, they eventually got to this thing called the Interest Equalization Act of 1963, introduced by John F. Kennedy, which had the effect of trying to stop capital leaving the country. The country that avoided financial repression after World War II was Switzerland, for the fairly simple reason it didn't fight in World War II and therefore it didn't have a debt legacy and it didn't have capital controls. But for everybody else whose legacy was that excessive level of debt, we either had them maintained post-World War II or we eventually, as an American, got there. Restricted investment list is a thing called the Trustee Act of the United Kingdom, where I simply gave a list to everybody on this call and said, here's the maximum amount of money you can have in equities legally as a fiduciary. And if you take a level in equities above that, you're in breach of your fiduciary duty. That's the Trustee Act. Transaction taxes, at one stage, UK stamp duty was 2%. It can go back to 2% or 3% or 4%. The crucial thing is you have to make other assets less attractive relative to government bonds. So there'll be no transaction tax on government bonds, high transaction taxes on equities. Let's force people into the government bond market. Wealth taxes we have in France. They reintroduced them in Spain a few years ago. I've mentioned the capital levy, which is not this annual assessment of wealth for the taking of it. It's just a one-off taking capital levy. Already suggested, certainly by a couple of German think tanks, not surprisingly, that the Italians should do this, that the Italians don't need EU money. They need to take money off their savers. Well, we shall see about that, but I think you can imagine the level of capital flight from any economy where you're expected to lose some money in a capital levy. Rent controls, we've got to keep the yields on property down to make those government bonds even more attractive. Rent controls, even before this, were coming back in. Berlin, Vancouver, Toronto, all introduced capital controls. Obviously, it's a wealth inequality issue as well, but it conveniently helps you make government bonds more attractive. These are the list of things that have happened, not the things that will all necessarily happen, but these are the methods of repression. And I think as I go through them, you begin to see why we're not in Kansas anymore and why the world has changed. Dividend controls just happened, particularly for banks. We've told them, not just banks, anybody who's getting any government assistance is really under big trouble if they start paying dividends. We have to make dividends unattractive because we don't want that dividend yield to be so attractive that it takes money away from funding government debt. Remember, government debt is a fundamentally unattractive proposition when it yields less than inflation, and yet somehow we have to persuade you to buy it. So we have to put up corporation tax. It was 52% in the United Kingdom not that long ago, closer to 19% now, and we can restrict the payment of dividends. Even in the United States under Nixon, and it's really important to stress this is not a policy of the left or the right. You don't have to sit back and say, only if there's a left-wing government will we get any of these policies. All of these governments have been used by governments of both the left and the right because they simply said they had no alternative. And it was Nixon who ramped up capital controls, but also brought in price controls and ramped up credit controls. It was George W. Bush who effectively nationalized the American banking system. So this is not about left or right. This is about what's essential in a crisis. And this is a crisis, clearly a health crisis today. But when the health crisis is over, the shadow is the great debt crisis. Restrictions on gold ownership, famously used by Roosevelt in April 33, not so necessary today, in my opinion, because there's not a lot of wealth in gold. All the gold in the world is a third the size of the Washington Monument. There's much easier pickings in pieces of paper and reallocating wealth in pieces of paper owned by financial institutions than going after gold ownership of individuals. Capital issues, restrictions. I just mentioned this to give you some idea of the scale of the change here. If I today wanted to make sure that my private sector didn't borrow any money in the next 12 months, which is an extreme situation, it's not going to happen, but I wouldn't need to control the banks. I'd need to control the banks and I'd need to control the bond markets. And that's a fundamental difference from 45. If we were in the business of really making sure that credit only goes to those institutions we consider to be doing something productive and not speculative, we're going to have to get in and regulate the capital markets, particularly the capital market for debt. I won't talk about the new measures at the end. You can read those. I think they're pretty self-explanatory. But hopefully that smorgasbord of repression gives you some idea, to me particularly, why this is so horrific for the Eurozone. Because there will be some governments with mandates to do these things, and there'll be some governments that don't. There'll be some governments that have debt to GDP ratios so high that they absolutely need to do this regardless of the complexion and regardless of their mandate. And there'll be some that don't. And how on earth, in a single currency with a single interest rate and one central bank, how on earth do you bring this off in a politically acceptable and a socially acceptable way for countries in very, very different scenarios? And that is really what I want to talk about. Can we get a financial, just excuse me a second, can we get a financial repression that works in the Eurozone? I'm going to show you the data in a minute, but the debt to GDP ratios in Europe are radically different. There are countries, particularly Germany and Austria, with low levels of debt to GDP that really wouldn't need to do a financial repression, even after the rise in debt that is coming along. How could we get, and I like to talk about the Eurozone rather than the EU, it's just much easier. We can talk about the other non-Eurozone members of the EU at the end if you like. But how are we going to get 19 democratically elected governments to agree on the list of that previous list I've just read through, all those measures? How are we going to get them to agree on all 19 of those? There won't be agreement on that. And if you can't agree on that, then how do you run a repression? The decision from Karlsruhe yesterday was profound. I mean, absolutely profound. And I'm amazed that the markets have taken it so well. It's a full attack on not just the ECB, but more importantly on the ECJ, which I think the markets, one court attacks another court. The average investor says, who cares? And this is something for the lawyers. But what the German Constitutional Court has done is push back against the right of the ECJ to ignore German law, not just German law, any member state's law. They're saying that EU law is not paramount. They're saying that it cannot be paramount. It has to be considered in relation to the laws of Germany and every other member state. Now that massively swings the pendulum away from the federalization project. And they go much further than that. They say the ECJ didn't even look at the evidence. And they said acted ultra vires. And I'm sure there are some people listening to this who've got degrees in law. It's an incredible attack. And it actually says that they acted contrary to the principles of democracy. And I can never remember one court being so clear on this. You say, well, I don't care. I mean, that's all legal stuff. What difference does it matter? Well, the penalty, the power that the German court has is to demand that the Bundesbank sells its government bond portfolio. That is the legal right of the German Constitutional Court. And that is what they're going to do in 3 months, unless they get evidence from the ECB that the last program, the PSPP that was launched in 2015, has been done on a proportionate basis. And I won't go into what proportionate means, but they will need evidence of that. They'll need the minutes. They'll need to see the decision-making process. And after 3 months, if they don't get it, they will ask the German Bundesbank to sell its bonds. And if the German Bundesbank sells its bonds under the current law of the ECB, the entire PSPP program would have to be unwound, as bond holdings are in line with the capital key. And if you had 24% of that bond holding disappearing, which is the German portion, you'd have to unwind the rest. I'm not saying it's going to happen, but it's putting the ball in the court of the politicians to find the federal answer. or not find a federal answer to this problem that Europe has, that it's only halfway towards being a federal state. So this comes at a very bad time for the Eurozone, because the levers of the federal levers are incomplete, and actually the German court has just destroyed two of the key federal levers, which were the court and the ECB, and said you're acting unconstitutionally. These things can only be done at the political level, whether it's the Commission or the Council or the Parliament, but they cannot be done in Luxembourg, and they cannot be done in Frankfurt. And that is how they have been done for some time, given the political paralysis. That is where they've been done. So this decision is really profound, and particularly at this time. So we've got two options for Europe. Either it federalizes very rapidly, and that will now have to be done very overtly politically, because the backdoor route has been ruled out by the German court, or it doesn't. I think it won't, and I'll come on to how I think it won't in a minute. Here's some of the data. You can see this gap in French and German debt to GDP ratio. I started in 1998 because obviously that's when the euro was created. And the gap then, this is total debt to GDP, the gap then was very small. It was 12%. It doesn't, there are reasons why you'd put two economies together into a single currency based on flows, fiscal deficits, current account deficits, but based also on stocks, on balance sheets. The debt to GDP ratios were similar. They are very, very far from similar today. This gap, by the way, since this data came out, has now gone to 147% of GDP. It is truly massive, and of course, this is the core of the euro. Can Germany bail out France? We'll see in a minute that the problem isn't really Italy at all. The Italian private sector is grossly undergeared. It's more undergeared than the Germans. Where we have the problem is in France, where the private sector is massively overgeared. We all know the challenges for the private sector in our current environment. Those challenges are going to go on for many months, but will persist for many years. We do this reconstruction. How on earth can two countries with a gap in the debt to GDP ratio is so huge, agree on a monetary policy and a repressionary policy that would be the same? It would have to be identical in one exchange rate. I think it's politically not just very difficult, I think it is actually politically impossible. And the answer to this is to sever that link, not by dramatically going to different currencies, but by bringing in capital controls across Europe, which is what I'll come back to as I go through this. That is, I think, what happens to the euro. We don't say the euro is over the same way the Holy Roman Empire was never really over. It's just restrictions on the free movement of capital within Europe. And gradually and slowly we begin to realize that this is no longer a single currency. This has happened already. It happened in Cyprus and it happened in Greece, and those capital controls were eventually reversed. But on this occasion, given the scale of the debt to GDP difference, given the history as to how long it takes to shift such huge levels of debt to GDP, I don't think this is a temporary shift when it comes. Here is the TIPS market, the French inflation protected securities government bond market, and it tells us what the market thinks is going to happen to French inflation. How on earth is France going to inflate away its debts? This is what we expect for inflation. It needs dramatically more inflation. Now, I made that argument 8, 9, 10, 12 months ago, and inflation expectations have shifted even lower. The debt to GDP ratio of France, if this forecast for the next 4 years of inflation is correct, is just going to keep going like this. Now, I'm not singling out France because it's got a particularly expected low inflation rate. Everyone's got very low expected inflation rates. I'm singling it out because it's got a very low inflation rate, it's got a very high debt to GDP ratio, and it's right at the core of the euro. And this is the problem. It needs to generate that inflation. And how on earth is it going to do it? Because it's not in the whim of the French government to create that inflation. It is within, or has been within, the power of the European Central Bank. Now, the decision of the German court potentially takes that power away from the central bank. Now, that you will say that's overdramatic. But if, as the court says, it is acting unconstitutionally and threatens the principles of democracy by its balance sheet expansion without without the stamp of political approval, there is a limit to how far that central bank can go. Now, the massive expansion of the central bank balance sheet to date has failed to generate inflation. Long before this crisis came along, it was failing, and France's debt to GDP was going up as a consequence. So we're getting to a very, very difficult time for the Eurozone, because that is probably for a couple of years a reasonable expectation for inflation, and for the European Central Bank to generate enough inflation to get rid of France's debts. Well, it doesn't have to take it back to 2014 levels or 2009 levels or 2005 levels. It's probably got to get it even higher than that. And then we have to ask how German savers would feel about that. In any society, a repression is a transfer of wealth from the older to the younger, from the saver to the debtor. It's politically divisive in any society. When it involves moving money across borders, when moving money from the savers of the north, if you like, to the debtors of the south, it is political dynamite. And I think it's why you can't really have a repression while you have expected inflation rates so low. If that expected inflation rate is right for France, France is bust. It is simply not going to grow out of this. So let's hope it's wrong. But I don't see the answer to this lying through the European Central Bank, I'm afraid. I see it lying somewhere else. And you might say, well, how on earth could this work? Because you need a central bank to generate money. France has the ECB. And the answer is you do not need a central bank to generate money. If we look at the last 10 years post-GFC, what we'll see is that central banks have failed to generate money. They've generated lots of bank reserves, but because those reserves were not utilized by the commercial banking system, it didn't generate high levels of broad money. If, however, the government of France seized control of its banking system and forced those banks to lend rapidly, which it is doing, as are most of the governments of the world, then it would create a lot of money. That's the joys of fractional reserve banking. We often call it fountain pen money, and that is where we've got to. It's different from 2008. It's different from any recession that I've lived through before, and it will create a lot of money. It is not compatible with a single exchange rate, though. If what is happening is that the power is now devolved from the printing press, i.e. the ECB, to the fountain pen providers, and each of those fountain pen providers of money is controlled by their member state. That is taking us away from a single currency back to something else. And there would be a coalition alignment of interests here, because the people, if the French are creating lots of money through their banking system, they really like that to stick in France. They don't want those euros to end up in a German bank account. The Germans similarly wouldn't want all those euros flooding into Germany. So there will be a coalition of interest in not allowing this money to slosh across borders. So it's not that great explosion of the euro that you often hear people talking about. It's the use of capital controls. And over time, we begin to realize that the ability to create money has gone effectively through the nationalization of commercial banking systems to somewhere other than Frankfurt. Here are the private debt to GDP ratios. Now, Ireland's very high on this, but you will be aware that that is not a proper reflection of the debt to GDP of Ireland. There are several countries on this list for Europe that are effectively, the polite word is, used for the purposes of tax avoidance, but not evasion. That's the polite term. Lots of large multinationals borrow money in those jurisdictions, and there are tax benefits to borrowing, particularly the Netherlands, even more so than Ireland. So I don't particularly point the finger at Luxembourg, Netherlands, Ireland, or Belgium in this, because they do have a certain element of foreign companies borrowing there, and clearly the debt of those foreign companies is not supported by local GDP. It's supported by something else. Probably the GDP of a multinational will be from all over the world. But France is not one of these countries that people borrow in to avoid tax. That number is a cleaner number for France, and it's 201% of GDP. Go to the bottom of this table and you'll see where we are for Germany and Italy. So this is just private debt to GDP. And you can see that vast gap between France, Germany, and Italy. The Italian number constantly surprises people, because even in very reputable newspapers, you often hear people say Italy's overgeared, and they're referring solely to the government debt to GDP, which is at a high level, and don't even talk about the private sector. Italy's corporations are on the whole family owned, and as family owned corporations, they've tended to keep debt to GDP ratios lower. They haven't been subjected to the whims of managerial capitalism and financial engineering to the same extent that other places have. And arguably that France somehow has, though I think most of us probably didn't notice it. So how do we solve these problems with one currency? And I'd argue that it would be incredibly difficult to do so, and would involve a scale of wealth transfer that politically wouldn't be acceptable. I want to draw the contrast between that gap in the debt to GDP ratio of France and Germany with these, sadly, that were called at the time the pigs, which were the four countries that got into real debt crises in our last recession. Remember, we're at 147% in terms of the gap in debt to GDP ratio between France and Germany. As we went in 2007, this was the difference between Germany and Portugal, Ireland, Greece, and Spain. None of them were anywhere close to having the scale of debt to GDP gap that France now has with Germany. Yet all of them found themselves in crisis during a recession that turned into what effectively for many was a depression, because that debt to GDP level, because the changes in monetary policy just simply weren't enough, because the debt burden was too high. Now that is where we are today with France, except that interest rates are already zero. At least in the last recession in Europe, we got a fall in interest rates, which could alleviate some of the pressures of excessive debt. But on this occasion, that can't happen. And France's debt to GDP ratio gap is 137. So you can see where the peaks got to in the GFC. Some of them actually got above France and Germany. Many didn't. Even at the worst point for Portugal, Greece, and Spain, the debt to GDP gap with Germany was pretty limited. So, I mean, I have a conclusion which doesn't go down well with people, and that is that France is too big to save. And one of the fundamental reasons that we have to reconsider the Eurozone is simply we can't inflate France's debts away given the current levels of debt. Now, we could pick other countries in Europe and say that, but obviously France is the important one because it's the German-French nexus that holds the whole thing together. And I'm afraid it's not going to work. We're not simply going to be able to do that this time. So if you think financial repression is the way forward, I think we have to rethink the euro. And to be clear, I think that is restrictions on the free movement of capital between countries. The state using the banking system to create money, the commercial banking system to create money, and slowly but surely a recognition that whatever this thing is called, like the Holy Roman Empire, it isn't actually the Holy Roman Empire. So here are the conclusions, because I have gone on far too long, as I did warn you. I have a license to talk, dangerous thing. France is too big to save. Each European country will have to inflate away its own debts. These extreme administrative measures, which I've run through already, I just don't think there'd be any agreement in that pan-Europe. Inflation will be created by the use of the commercial banking system, and that can pass quite quickly into the local member states, and arguably may have happened already. But you need to stop capital flight in that system. Otherwise, if all the euros you create would simply go to somewhere where they thought they were particularly safe and where they weren't going to be repressed. At the minute, that would probably be the countries with low debt to GDP ratio, which are Germany and Austria. So the whole thing just doesn't really work without capital control. So whatever we might call it, in effect, that's the end of the euro. So invest in jurisdictions where there isn't going to be repression. These are my key final conclusions. And how you judge that, you look at debt to GDP. If debt to GDP is relatively low, it's not necessary to go for repression. So I think it's Singapore, it's possibly Switzerland. And there may be other emerging markets on that list. We just have to wait and see how the debt to GDP ratios pan out, but they're certainly starting from low levels, whereas the developed world is starting from very high levels. Be very careful of buying any emerging market with lots of foreign currency debt to GDP. Exchange rates go down and suddenly debt to GDP goes straight up. You have to look at those completely differently. I list some there, and I've long talked about Turkey. I see the Turkish lira is at 7.11. How appropriate today. Sell advanced economy equities. Now this isn't really would be a much longer debate, because we could do 40 minutes on this alone. Read Buffett's How Equities Swindle the Equity Investor, which is in Fortune magazine, 1977. Inflation isn't necessarily good for equities, though I argue here it may be good for equities that are very capital intensive and have a high fixed cost base, depreciation, but also long-term debt with fixed interest expense. But for equities in general, profit margins are coming down, not going up, corporate tax is going up, and I would argue strongly that the right and ability to deduct interest expense in the computation of corporation tax is also going. China will devalue its exchange rate. It will have to get aggressive to reflate that economy. And how do you get aggressive if you've linked your currency to somebody else's? Somebody else really determines and ultimately sets your interest rates. That's been fine for a long time, but there is no trade. And China isn't going to be a mercantilist country forever. It can't expect, as the second biggest economy in the world, to constantly run surpluses against someone else. So it's over. Mercantilism is dead. And if mercantilism is dead, you need a monetary policy that isn't mercantilist. And that means just like everybody else in the world, or virtually everybody else in the world, setting the price of money and the quantity of money at the right level to generate domestic growth. And if China does that, it doesn't run a managed exchange rate. So you can see that the implications of this are very positive for the dollar. If we're right that this euro is facing structural problems and China devalues, the dollar continues to go up despite all the efforts of the Federal Reserve to stop it through swap lines. Bonds or certificates of confiscation. Gold is a buy, negative real rates for a prolonged period of time. Gold is a buy. Even if we get deflation in the short run and real rates go up, gold is still a buy, because in a financial repression, you're expecting capital levies, wealth taxes, and gold has always been something that benefits from the rise of the word control. The decline of the word market is a bull market for gold. Credit is politicized, so if you're invested in a company or an asset that's just simply been geared and geared and geared and geared, but with no productive use, commercial real estate springs to mind, private equity springs to mind, it's over for that particular form of asset class. The society can no longer afford to live with those levels of gearing of existing assets, and something will be done to stop it. I think I've kind of probably got there when I look through these. So that is what a financial repression is over, and it just finishes on the era of markets is over and the era of control returns. What you can do is try and read as much as possible about how the system worked from 45 to 78, 80, 81, that sort of time. I recommend David Kinniston's book, which is 4-volume history of the City of London. The final volume runs from 45 to 2000, so you just get some idea of how that was a very, very different world. So I was given a license to talk, and what I usually do in 30 minutes, I've now done in 55 minutes. But following those 55 minutes, I welcome any questions. Just a reminder that I write every 2 weeks. It's on Eric. Eric's free to get into for anybody who works for a regulated financial institution. So there's going to be a lot of twists and turns in this story, and you can follow them on Eric. And now I suspect there'll be 1 or 2 questions.
Yeah, there are actually a few questions. First, I want to say thank you, and I guess CFA France will not be inviting you for a webinar in the near future. Actually, I wanted to start with a little bit of a naive question, and I don't want to come off as a supporter of MMT, but essentially status quo of the public debt has changed drastically after the GFC, and why would we want to pay it out at all? Because I was thinking from the perspective of currency, essentially currency is some form of the government debt, right? And we've moved past the time when we start linking currency to the gold, right? And we don't even think about it in this real terms. So what if eventually we get to the point where we start thinking about public debt in its real terms, and maybe there's a new asset class which will emerge, which will be more, will have high yields, but can have the same function as the government debt, and the governments will just let it grow as far as they want. In this way, we not facing financial repression, and this is something that MMT argues for. What do you think about it?
Okay, well, I mean, there's a finite amount of savings in the world, and what the MMT guys argue is that we don't need to utilize savings at all to fund the government. We just print money and hand it to the government. If I understand your question, it is there something else that savers could own? But there's only a finite amount of savings. So I think whatever savers are going to own, the question is the price, and the question is whether the government can afford the price. And the price that savers would demand, let's give a practical example. Let's say inflation did get to 6. The price that savers would demand for the yield on that is just something that governments couldn't even contemplate paying. So I find it hard to think of a new government asset class that could pay the price that you would want to pay on it. But I should have said very clearly that financial repression has something of the MMT about it. So the way we solve this problem, and it's kind of this fusion with MMT, is that the central bank buys all this government debt and holds it forever, and it ceases to be debt. So to that extent, we're taking a major step towards MMT, because once these government bonds are on the central bank balance sheet, they cease to be debt. What the MMT guys won't tell you is that the other side of that must mean that the government must control the commercial banking system. But as we've kind of done that anyway, we're already there. So you're coming up with an innovative solution to sort of milk the savers in a different way. Maybe we don't need it, because we have the central banks being so aggressive at buying debt and just holding it in perpetuity. And it really isn't dangerous as long as you completely destroy commercial banking. So I don't know if I've missed the question there, but financial repression really is a bit of MMT in it. And we don't really need to create new wonderful asset classes when we have got free credit flowing from the central banks to the government. But you can't allow the saver to get a much higher yield than everybody else. The governments couldn't afford it.
Yeah, I guess what I imagine is that MMT would be a more positive story than a financial repression, because you've put us into a really sad mood today.
It's the same thing. That's kind of what I'm saying. I'm looking over to my right because I can see my copy of Modern Money Theory by Randall Wray. And if you, which is the kind of go-to seminal textbook on MMT. And if you read that, although it's almost in between the lines, what you see is that all the policies that have to flow from MMT are financial repression. You know, he talks about capital controls and restricting capital controls, says how that might be necessary if the exchange rate would collapse. So I can rebrand the whole talk and say it's partially about MMT, but financial repression really is something about MMT. But the thing that the MMT's guys don't tell you is that for it to work, in their terms for it to work, you have to crush a free movement of capital. You have to crush savers. That's all part and parcel of MMT, but they just don't tell you that.
Okay. I had a few questions about the equities and what about the gold price. So just if you have a view on what level of valuations equities could reach, and obviously how far the gold can climb in the near future.
Sure. So I've written a book on equity valuations and how they get to lows, and there are two ways they can do it. With inflation, they tend to get there very low, slowly in the long term, and with deflation, they tend to get there very quickly. And where do they get to? Well, the history of the US stock market is we get to a cyclically adjusted PE ratio of below 10, and we're currently, I think, at 25. So that would give you a pretty good guide as to how low valuations could come. However, it's a big however. Let's say that we generate growth and too much inflation, i.e. a very successful financial repression. No deflation first, just a successful financial repression. It could take another 15 years to get equity valuations to their lows, assuming that, as I do, and I can talk about it if you like, why there has to be a mean reversion in equity valuations. It could be that way of doing it. In other words, people seem to think that all bear markets are about earnings collapse, share prices collapse, earnings bottom, share prices pick up. That's absolutely not true. Two of the great bear markets of the 20th century ran from 1901 to 1921. In America, which was developing as the world's economic superpower. And then again from 1966 to 1982, both against a background of growth, both against a background of inflation. But it's back to what Buffett told us, price is what you pay and value is what you get. So I think equities will go below 10 times earnings. I'm not going to tell you exactly how quickly that will be because it depends on whether we get the deflation or the inflationary answer to it. But if you get in the long run financial repression, you'll get very low equity valuations anyway. So you can either get them in the long run or you can get them quickly through a deflationary collapse in earnings. So much lower. The good news for markets outside the US is they're much cheaper. Capes are much, much lower elsewhere, so they wouldn't have just as far to fall to get to cheap. The great conclusion of my book is that when equities are cheap, you buy them anyway. They can discount almost anything. And that is really a crucial conclusion from financial history, that, price is what you pay, value is what you get. When they're cheap enough, you buy them. So I'd like to see this all over quite quickly. I'd like to see equities very cheap very soon so we can all buy them. So I hope it happens that way. In gold, I don't have a gold price target. I think it's impossible to put a target on something which has no fundamental. Gold has no fundamental. In anything else we value, we value it relative to an earnings stream. You can concoct an earnings stream from gold by lending it. But to try to value something with no earnings stream it's difficult enough to value things with earnings streams, equities, bonds, property. To value something without an earnings stream, I don't know. I think it's too difficult. But it's certainly going much, much higher in a financial repression. The problem with the last financial repression is that gold was pegged to the dollar for most of it, from the whole 45 all the way to 71. So the gold price didn't move in dollar terms. So you say, well, was gold a good store of value in that situation? Well, it was linked to the dollar. But as soon as that link was taken away, it went from 35 to, I think, over 800 in the space of 10 years. So if you like, there was a great catch up from the gold price. So I think the histories of financial repressions are pretty easy. Gold goes up and it goes up a lot, and you should resist all temptations to sell it. There's an interesting little 1977 bear market in gold, and I think it came down over 30%. And of course, many people would have thought that was the end of the bull market in gold, but it just kept going. So don't own government liabilities, own gold, and I don't know what price it can get to, but the bull market should be intact for decades rather than years.
Can I ask you to stop sharing your screen, actually?
Oh, yeah, of course.
I was supposed to remind you about it.
Okay.
So I have you shared quite a pessimistic view. So one of the attendees actually asked, how did you vote in Brexit?
Well, I voted for Brexit because not on any economic grounds, but I voted for Brexit on grounds of democracy. So you either move to a full federal state and have a democratic federal state, or you don't. And to do that, you need the electorate to sign up to that in a referendum. So I've long argued that Europe should have referendums. It should put to the people what the final constitution of Europe should be, and then we should all vote on it. And we may well vote to all stay in the European Union. But they've refused to do that, constantly, steadily refused to allow the people to vote on a referendum or even to put the constitution forward. So that's because they can't agree on a constitution. But really, this is really, really, really important that we are told what the constitution the constitution that is necessary to make the currency work, and then we all get to vote on it. And we can't live in this halfway house. And I'll tell you a little story that I've told before about what made me get very worried about the whole thing. When I lived in, this will take a couple of minutes, I'm afraid. When I lived in Asia, I did a presentation to the French Senate. A committee came to investigate the French the Asian economic crisis. And in my opinion, that was a crisis delivered by trying to link all the currencies together to the dollar. And I couldn't help saying that if you created a euro, you'd also create massive imbalances. It would be just natural you can create these imbalances, and eventually they would implode and you'd get a crisis. And I think that has been borne out by history and what happened in 2011, 2012 in Europe. And anyway, I was told by the French Senate, or the leader of the French Senate committee, that this was a disgraceful opinion to have, because what I didn't realize is that the imposition of the single currency would make Europe more the same. Europeans were very different, but a single currency would grind down these what he called inefficiencies. And that single currency, if it destroyed all these inefficiencies in Europe and made Europe all the same, it would create a more integrated and harmonious Europe. And my reply to that was, well, if you do that, you'll destroy the culture of the countries of Europe. And if you want to destroy the cultures of the country of Europe, you're more likely to start a war than to stop one, at which stage I got a standing ovation from the communist and the fascist in the room. And that's what made me very, very worried about the euro. I thought this is the path to power for communism and fascism. Now, from the entire 20 years that I've been saying that, people keep telling me I'm as mad as a hatter. But as we sit here today, the Italian far right has 45% of the polls. Viktor Orban has basically suspended democracy in Hungary. And you might say, well, that's not because of the euro. Well, I think you're wrong. I think, I'm nothing against the European Union, but I think, and I would never have voted for Brexit if there had been a European Union, but I think the euro has forced a form of integration on Europe, which it simply wasn't ready for, has no political mandate for, and risks handing power to the extremes of politics. So that is my reason for voting not to be in the European Union. But if they get rid of the euro, there may be reasons why the United Kingdom could rejoin. Because I think without the euro, the thing can work, and it can work very well. And I think it was working pretty all right up until the introduction of the euro. So anyway, that's a very long answer to a very simple question.
Oh, it's interesting. I think how you call about the federalization is actually them dropping the euro is something that opposite. So they have to move other direction in order to fix the things. But like with the environment, like what's happening in the US, for example, with an extensive monetary stimulus, it basically pushes Europe taking the same direction in a way, which makes those decisions a bit more difficult for Europeans.
Yeah, well, look, Europe either rapidly goes to complete federalization or goes the other way, but it can't stay in the middle. That's the problem. And this is a situation that would never have arisen if you didn't have the euro, because everybody would have independent central banks, so they could kind of get on with it. So it just needs to make a decision. And my call is it will make a decision to go the other way. But I'm sure many people watching this will say, no, it's going to jump towards federalization. Well, we will see which way it goes, but it simply can't sit in the middle. Not after what happened in Karlsruhe yesterday. The European Central Bank will not be able to inflate away Europe's debts, full stop. Not unless Europe endorses it to do so, and to do so it will need to be very federal in nature, and it better hurry up.
Well, we will certainly watch it, and hopefully maybe have you back in a couple of months talking about it. I have another question. So you mentioned that everyone should be owning gold, but one of the examples you brought up that US stopped private investors holding gold at some point. How do you see this happening again?
Sure. So what I probably didn't stress enough in that is that one of the secrets of financial repression is not to hold your money in a regulated financial institution. Regulated financial institutions can be told to do anything. So for instance, if you were working for one at the minute, which was 20% in gold, but the government mandated that you needed to have 70% of all your money in government debt, you'd probably have to sell some of your gold. The fundamental difference from 1933 and 1945 is that most of the wealth of a country is no longer held in the hands of individuals. And I'm doing it from memory, but I think at the end of World War II, roughly 60%, perhaps more, of the UK stock market was held by individuals, and now it's about 15%. So if I am the state and I need to repress the savings system, I can just come to the regulated financial institutions and I can get them to sell their gold and buy government bonds. So I think that will happen. However, if you're an individual, you're so far down the list of where the money is that I think, they might get to you eventually. But all the easy pickings are in the regulated financial institutions. So do I really have to come after the gold owned by individuals? So perhaps I should have been clearer. I think it might be more difficult to own gold as a regulated financial institution than it would be as an individual. But as an individual saver, you should own it. As a regulated financial institution, you should also own it, but you may find in due course that it is, if we go back to the Trustee Acts of, I think it was 1924, gold will be one of the assets that a fiduciary is not allowed to own, but I don't think that'll happen to gold held in the name of individuals.
Second. Okay, I have been told to have two last questions. Actually, have two more questions. One is, in one of the podcasts, I think I listened to like 2 months ago, you mentioned that when investors looking for a country to look at, is obviously investors should look at the country with low debt. However, you mentioned Japan as the example where corporates have lots of cash in this environment. So I wonder, like, what is the balance here? Because Japan is obviously a country with a huge amount of debt, and probably public debt is quite enormous as well.
Yeah. So before COVID-19 came along, I was very worried about the yen because I thought Japan's debt to GDP ratio was so astronomical that it would have to do some very extreme policies which would push the yen lower. That was wrong. But what's happened with COVID-19 is we're all basically in the same boat. We're all having to do policies which are as extreme as that. So if we're all having to do policies which are that extreme, you shouldn't expect anyone's particular exchange rate to be punished for following such an extreme policy. So the yen may be genuinely a weak currency, but the collapse of the yen because they had to do something aggressive on inflating away government debt is no longer likely because we're all going to be in the same boat. In which case, you shouldn't book a large exchange rate loss by holding yen assets. But you do want to buy equities where there isn't going to be government bailouts or bail-ins, or where your position in the capital structure is threatened by government capital coming in. We did see it didn't really work out very well for banks that accepted government capital in the last bailout. It worked out quite well because there's still a value in the equity, but it didn't work out very well in the subsequent return. So because of the nature of Japanese corporate balance sheets, I think that's a place where you do want to invest. And I just kind of ask a question to everybody who's watching. Some people watching this will run equity income products, and you know what's happened to equity income. Dividends have been slashed. Could it be that a year from now, a global equity income fund is heavily invested in Japan? Yields will be low, but they may not be actually that much lower than anywhere else. And most importantly, because of the nature of the balance sheet, they are sound and secure dividend yields. And if you're selling an income product, that's what you want. So I think in a year from now, we'll see a lot of allocations to Japan for income, which just shows you how much the world has changed in the last 30 years. So despite the very high government debt to GDP ratio, I would own Japanese equities. If I had to own equities at all, I would look to own Japanese equities, but particularly obviously those ones with very sound balance sheets.
Okay, so actually I'll look through the Q&A section, and there's quite a few questions on Bitcoin. I wonder if you think whether Bitcoin will have a similar store value as gold.
No.
Or any comments on Bitcoin you have. I think it's very
absolutely not. I mean, Bitcoin is.
Yeah, you showed us your coins already, right? So
I showed you some earlier on, and Bitcoin's like baseball cards. I just don't see the point of Bitcoin. It clearly isn't a currency. It can't be a currency. It will legally never be a currency. It would strip power away from the governments, and that will never be permitted. So I've actually accidentally been to a couple of Bitcoin conferences, or I've been passing through the airport at the same time as Bitcoin conferences. And I noticed that everybody who attended a Bitcoin conference that I saw had three things in common. They were male, they were exuberant, and they were under the age of 30. So I'm a 55-year-old, I'm not going to be able to understand Bitcoin, but I would point out that throughout financial history, there have always been asset classes that have only been understood by young men with high testosterone. And on the whole, they haven't tended to produce good returns. So I see Bitcoin as more a lifestyle choice by young people who think they are rebels. And that's good, that's nothing wrong with that, but I don't think you'll make money owning it.
I think because attendee level didn't suddenly drop, we can have some assumption about the average age of our audience. Actually, I know that a lot of central banks are now exploring opportunities to have their own cryptocurrency. Do you see this as a way to stimulate the economy? Like, I know, for example, when China started opening up, what they did is they started issuing QR code for particular products. So like public can go and spend on particular products, right? It gave me a flashback of a stamp system back in Russia a long time ago. But it has the same system, right? The same idea, and it's a way to make people spend rather than using the force of capital markets, which is probably better.
I think all those things are very, very possible, but those are not cryptocurrencies. Those are just currencies. They're just currencies. It's got the stamp of the state on it. It just happens to fluctuate in a different way. As you point out, it's kind of, you can time limit them, which is really good to stimulate consumption. And it wouldn't surprise me at all if we got to something like that. Why on earth would this be good for Bitcoin? I mean, the government can't allow these competitor currencies to continue to thrive and exist and become means of transactions or stores of value. And the more they develop their own, the more they really can't allow there to be other stores of value and means of transaction. And I think people who support Bitcoin say, well, we're more powerful than the government, so we can absolutely do that. Well, I think they're wrong.
Now this came to stop. Can I have one last question, please? Just one, I'm sorry. I know you've been saying a lot of about US and China relationship, and you highlight a lot of risks that are related to RMB devaluation. Because recently we've seen another escalation between the two. I wonder if you have any comments or outlook with regards to this relationship.
I mean, it's a Cold War, and it doesn't really matter who the next president of the US is. It's going to be a Cold War. It's been brewing for a long time. Once again, there's about a 40-minute presentation on that. I would just flag up one thing which people have to look out very carefully for, which is America is trying to put intermediate range missiles in Asia. It ended the missile treaty with Russia, with Mr. Putin, and that's nothing to do with Russia. It was to do with the fact that China's building lots of missiles and America wasn't able to. One day, and I don't know when it's going to be, somebody in Asia is going to accept those missiles. And for all my hypothesizing and speculating about a new Cold War, the day that first missile arrives is the day that the markets wake up and realize this is a Cold War. And in the last Cold War, capital did not flow cross-border, trade did not flow cross-border, people did not flow cross-border. That's the nature of a Cold War. And if we just think for a minute what the implications of that are for everything we do for a living, that movement of capital, goods, services, and people comes to an end in a Cold War. It is a bigger shock than COVID-19, and it lasts for a long time. So everyone has to make their own minds up on this Cold War thing. None of us are really qualified to do so. So what I say to people is, go on as normal if you like, but then that first missile arrives in Asia, realize that China will retaliate. I don't mean militarily, but China will retaliate. Something will happen. And what's been interesting so far is China hasn't really retaliated in terms of what America's been doing. And I think they've not retaliated because they just hoped that Donald Trump would go away. And it may well be he is about to go away. But I look at the platform that both Biden and Warren ran on. I assume Warren will be the vice presidential candidate. They're both pretty anti-Chinese. So I don't think the Cold War goes away, and COVID-19 may actually intensify it.